Hello there, Chevron employees, and welcome. Thank you so much for joining us today. We truly appreciate your time here. In just a second, we'll be joined by one of our Chevron-focused financial advisors. His name is Wesley Boudreau, and he is going to be covering some things related to current events happening at Chevron, such as interest rates, how to take your pension, and also anything related to any potential layoffs happening over at Chevron currently. Before he comes on, just a couple housekeeping items. First and foremost, please be reminded we are not affiliated nor endorsed whatsoever by Chevron. We are a completely independent group of financial advisors here. Please keep that in mind as you're listening along with Wesley today. Second off, throughout his presentation, you will see me entering some links. They will pop up above his head. They're going to guide you to some very valuable resources, such as our calendar, where you can book a 15-minute block of time. It is completely free to speak to one of our Chevron-focused financial advisors to answer any questions or cover any concerns you may have about any current events. You can also follow us on YouTube. You can follow us on LinkedIn. We post tons of Chevron-related content weekly, and we really think you'd get some value out of it if you considered giving us a follow. Lastly, Wesley should have time today to answer one or two questions. I apologize in advance if he does not have time to answer your question specifically, but I encourage you to still ask away. It is completely anonymous, and I will field your question to one of our advisors to answer with you either through phone or email after the presentation has ended. And with all of that out of the way now, we're going to jump over to Wesley Boudreau.
All right, thank you very much for that introduction, Samantha. And like she said today, we're going to talk about some different topics that are obviously front and center for a lot of the Chevron employees we work with right now. They're going through EOI, expression of interest. We'll dig into kind of what that means, some different questions to ask. Talk about the LTIPs and the different stock incentive plans for PSG 26 and higher. As we'll try and go through that somewhat quickly because I know it's not going to cover everybody, but rest assured if you have questions, want to dig into it deeper, give us a call. We can go through that. We'll talk about the pension plan, give you kind of an update on where interest rates are. We're a couple days away from the newest rates getting updated, so we'll, if you have any interest in that, make sure you sign up with us afterwards to get updates. And then we'll go through the Social Security offset, some different things to be aware of in that if you are transitioning. And we'll also kind of give you just our general advice and kind of where to go for the next steps on running a cash flow analysis and getting in touch with one of our Chevron-focused advisors. So first and foremost, expression of interest, what we're going through right now, that's going to be essentially an ability for you to say, okay, I'm thinking about leaving. It's a way for Chevron to institute voluntary separation instead of involuntary. We'll talk a little bit about that. We'll talk about some questions to consider if you are thinking about, hey, if I raise my hand, is it a good time? Should I raise my hand? Am I eligible? Should I work longer? Can I go early? We'll talk about, again, those different incentive plans like the LTIPs for those that are PSG 26 and higher. And we'll talk about the the retirement restoration plan for those that are, it's a non-qualified plan for those that are highly compensated employees as well, what those payout options are, and then we'll get into some others. So expression of interest, like I said, really it's the, hey, I'm raising my hand, I'm thinking about going because I want to take advantage of this, I want to take advantage of maybe I'm almost about to retire. Maybe I'm a couple of years from retirement. I want to get that severance package in there. I don't want to have to transition and move cities or states or move positions. Or maybe I just want to take that and move on and do something else for a couple of years. We've seen all these different options. So that's really what the expression of interest does. It says, hey, Chevron, I'm okay with potentially going, or maybe I want to get reassigned. So they're going to find out, okay, who is looking to potentially move, and so we can use them before we have to get to the involuntary separation options. So it does help out the company quite a bit, and again, if you're getting that severance package, it could help you out a bit as well. But again, there's a lot of things to consider, and is the timing right for this? We've worked with, we've gone through a lot of ROMs in the past and expression of interest, and sometimes the timing is perfect, sometimes it's not, so we got to be careful and run through that with the cash flow analysis. So some questions that we've kind of drafted here to consider and things we've always seen is, number one, am I ready to retire? There's two aspects of that. There's a financial aspect, which you can lean on us to kind of dig into and show you. But there's also the emotional aspect. You may not be ready to retire. You may have always kind of had in your mind, I'm working till 60, and maybe you're 57 right now. You're figuring out, okay, what do I do with those next 3 years? Or maybe I wanted to work until my kids go to college, or my kids are out of college, or something like that. So it may be kind of a new situation sprung onto you. So you need to figure that out emotionally, not just yourself, but if you're married, have a family, have that conversation as well. We can kind of help you through a cash flow analysis and reviewing the financial side of it, and maybe that can help you in the emotional side as well. Can I retire? So again, same kind of thing. Um, have I saved enough? Am I at a point where I can actually retire, or do I need to go back to work? Do I need to say, okay, I'd love to do the EOI, but I really can't. I need to stay on, and I need to suck it up and maybe look for a different position or something of that nature. Or maybe you do decide to take it and go elsewhere. So how does the pension plan, the savings plan, kind of factor into this, and how do those benefits work out for me based upon your age and other items like that? For again, PSG 26 and above, there's different things like how the stock option, the LTIPs, the RSUs, the PSUs, how's all that impacted? Because those are definitely some changes to be factored into. And then what about healthcare coverage? How is my healthcare going to look? How much more is it going to cost me as a retiree versus an employee? How close am I to Medicare eligible? So we go through all those different things. And really the last one, do I have a plan in place? That kind of goes back to that first one. Like, am I ready to retire? You don't know unless you have a plan in place. We've talked with a lot of people that our goal is to catch you maybe 5 years out from retirement so we can plan ahead for all this. But we've talked to a lot of people that said, hey, I got tapped on the shoulder last week and I'm about to go. I need help in planning this, and we need to go through there. And we can back into what are you trying to achieve. Maybe you are ready to walk out and you're good to go. You've saved enough. Or maybe we can back into saying, hey, I might need to work another 2 more years. But instead of focusing on the income, maybe I can focus on the quality of job and something like that. So again, we can go through all those items for you. So get into the PSG 26 and higher, so the LTIPs. Again, we're going to kind of go through some of this high level, but if you have any detailed questions, give us a call. If it doesn't affect you, you can glaze over for a little bit. I'll get to the pensions information in just a second. But normally this is forfeited if you separate before February 10th of a year. So again, we're obviously not in that case right now. There are age restrictions, age and service at termination does affect the vesting of this. So if you're over 65 or you have 90 points, you're typically 100% vested there. So 90 points refers to your age and years of service. So let's say if somebody is 60 with 30 years of service, that's 90 points, so they're 100% vested. If you're not there, is partial vesting if you're 60 or have 75 points at termination. So again, we can go through all this with you. This is handled through Morgan Stanley, so we don't have direct access to the accounts, but we can get a statement, kind of run through that with you and walk you through how that's going to play out. And then termination could definitely affect the benefits that you get there as well. So going into these LTIPs, looking at the restricted stock units, this is going to be a where you're getting restricted units that have a 5-year vesting schedule for you. They are taxed at ordinary income plus Social Security taxes upon the vesting, not when they're granted. So if I'm with Chevron and they say, hey Wesley, we're going to give you 500 shares of restricted stock units right now, I'm not going to see those for 5 years, and then once that happens, then I'll be paying taxes and FICA taxes on those as well. And they are paid out in stock. It used to be cash, but they're paid out in stock. So we could actually see somebody who's been getting these, year by year, actually leave the company right now and still have restricted stock units vesting over the next 5 years and still generating income that's going to be taxed and plus have Social Security tax on it. So it gets into some planning aspects and what you do with that and how do you manage that in the long term as well. As far as performance share units, a little bit different, a little bit shorter vesting period, 3 years on that. Again, I don't need to go through the whole calculations, but they use it based upon a 20-day moving average and the performance share multiplier in order to generate what those are going to be. It's based upon how they're doing against the oil and gas industry. Once they do that, it is taxed at ordinary income and plus FICA, so again, Social Security taxes. Same thing now, paid out in shares, not cash. So again, depending upon where we are in the cycle, we've seen the Chevron and the entire market fluctuate quite a bit here recently. But depending upon where we are, that could be good, could be bad for you. Stock options, again, this is going to be something that's a little bit different where you get the option to exercise those stocks. Maybe they give you a stock option at $100 a share, and then the stock's trading at $130 a share. So you got that $30 difference in there. So there's two types. There's non-qualified and there's also incentive, but most of the time we're going to see the non-qualified stock options there. There's a 3-year total vesting with a 10-year expiration to exercise those. So again, it's 33% a year, so a third a year. So if you were to get let's just say 1,000 shares in stock options, so 333 shares are going to be vested each year. Doesn't mean that you have to exercise them immediately. You have 10 years in order to hold on to those and exercise them. Depending upon where it's trading and depending upon your tax situation is what may drive you to either exercise them at vesting or defer. And there's various exercise methods to look at there. You can look at the same day sell, where you're essentially going ahead and exercising to purchase and then sell on the same day, so you get that net. So in that example I gave you, $100 stock option, $130 share, so get that $30 profit in there. A sell to cover, where you're actually selling in order to cover the cost in order to purchase. So you reduce your overall stock there. Cash exercise, we rarely see that. That means you're having to pony up the cash yourself, come out of pocket to buy those shares. Or a stock swap is going to be really like a cashless exercise where you're using the stock in order to do that as well. Again, tax and ordinary income and FICA taxes, because this is all considered deferred income. It's all an income source above and beyond what your typical salary or bonus may be. And there are short-term and long-term capital gains to be associated with this once you exercise those. So depending upon how long you hold them, if it's under a year you sell it, it's going to be it's short-term capital gains, so ordinary income, not FICA this time. And over a year, it's going to be long-term capital gains, so typically lower, either 0, 15, or 20% capital gains. You do need to consider leverage on this whenever you transition, because again, the options price are going to move in a leveraged case. So if Chevron's trading in one direction, the options may be exacerbated by that, because again, there's leverage in what you can have there. And so it's really important to consider that and align it also with the taxes. So if you do have stock options, I'll give us a call. We can run through a full detailed analysis of that. We can also get into different ways once you exercise that to generate additional income if you're looking to hold on to it, do a cover call strategy, different straddles. There's all kinds of different things we can look at in that options realm. So the retirement restoration plan is going to be the 415 limit plan. So again, if you're maxing out that 401k, you're a highly compensated employee, it's a non-qualified plan that goes in there. And upon retirement, you're going to have to get that paid out to you. And you would have had to elect how you want that paid out initially, either over a 10-year period or a lump sum. So obviously, if you're getting that lump sum, it could be a big hit tax-wise here if you're leaving this year, especially on top of if you're getting a severance package or something like that. They do give you the option to actually make a change kind of up to the last minute or once. However, if you do that, you're going to be forced to kind of defer that out for 5 years. So it may or may not be a bad decision, but it's definitely worth looking at. And as you let that sit in there defer, you're just going to get the 10-year treasury. So you may not get the growth you were hoping, but again, it may save you in taxes. So it's important to tie this into an overall cash flow analysis to see how the taxes pan out for you in this transition period. So let's get into the pension plan. So those of you that did gloss over earlier, we can get back into the nuts and bolts that everybody's going to be affected on, and that's the pension plan. Now this is for the classic defined benefit plan for those of you that were hired before 2008. If you're post 2008, you've got that cash balance plan, so it's a little bit different. You're getting those credits in there, and you're letting it grow based upon Treasury. So these higher interest rates we've seen are more beneficial for you. They're negative impact for those of you that are in this plan, the original plan, when you come to a lump sum calculation, which we'll show you in just a moment. So classic defined benefit plan, it's 1.6% times your years of service times your final average pay minus Social Security offset in order to give you what your specific single life annuity is going to be. And then from there, everything else is calculated. So what's going to happen too is you got to be careful about this Social Security offset. I'm not going to say this happens to everybody, but maybe 5 to 10% of people we do come across, we need to review this. And so what happens is they do a Social Security offset because essentially over the years, you've been paying half your Social Security FICA taxes, and Chevron's been paying the other half. So I'm not going to say claw back, but they're calculating this back out on the pension. So they take a little bit lower multiplier, 1.3% times the 1.35% of the projected age 65 Social Security times years of service up to a max of 45%. So again, what's going to happen is you got to look at that age 65 Social Security, and Chevron may or may not have that correct. And I'll talk about that in just a moment. So a quick example, let's assume that somebody's projected, this is from Chevron's standpoint, 65 Social Security is going to be $3,000 a month. Their years of service is 30 years. So that's 1.35 times $3,000 a month times 30 years. That's going to come out to $1,215 of a Social Security offset. So let's assume they went through that pension tool and determined that their single life annuity is going to be $4,000 a month. So instead of $4,000 a month, once you factor in the Social Security offset, it's going to be a little bit below that $2,800 figure. $2,800 figure instead because of this Social Security offset. Now let's pretend that individual actually didn't work for Chevron their entire career. Maybe the first 10 years they were in the public sector, they were a teacher or something like that. Then that Social Security offset may be slightly different. So what's going to happen is we might say, okay, well, We take a look at this. Since you haven't worked with Chevron your entire career, your actual Social Security numbers might be lower than what they're projecting at 65. So if that's the case, we can go ahead and submit that in writing to Chevron and have them recalculate that. And it may come out that because that calculation changed, it might save you, you know, uh, 50, 100, $300 a month or so in pension. Could correlate to 10, 15, 20, $30,000 more so in the lump sum. It depends case by case, but it's a double-edged sword. If you just go in there and say, "Hey, here's my Social Security," and you didn't talk to us, and your Social Security is actually higher, which is the case for a lot of people, they're gonna dock you on that, and it's gonna cost you some of your pension. So be very careful about that. And you pretty much have within 6 months after retirement in order to get that corrected. So again, if you've had any changes, or if you had like a break in service, maternity leave, and came back after a while or something, give us a call. We can go through this and let you know where you stand actually. So what are my options on that pension plan whenever it comes due? So like I mentioned before, there's that formula that gives you that single life annuity. That's going to be the annuity payment. I'll go back to that example I gave of $4,000 a month as an example. Let's assume we go through that even after the Social Security offset. They're going to get $4,000 a month, for instance. So from there, you can have other annuity options. Maybe you want a period certain where you want to make sure that if something happens to you, it's going to be paid out over 10, 15, or 20 years. So let's say if you were to get a 20-year period certain, you passed away in year 17, there's 3 more years of payments that can go out to your beneficiaries. Now it's not going to be $4,000 a month because what's happening is now there's a higher risk of Chevron having to pay you at least the 20 years, so it's going to be a little bit lower than $4,000. And if you did a joint survivor annuity, if you want to make sure that your significant other is taken care of if something were to happen to you, that's going to be definitely less than $4,000 example because they're going to use 2 different lives. Depending upon the ages and mortality tables, it may be a lot less, it may be a little bit less. But essentially, there's more risk to Chevron because there's 2 people that they're trying to pay out for. So the chance of you both die at the same time is pretty low. So somebody's going to live longer than the other, and they're still going to be in the hook. So you can sit there and say, instead of $4,000 a month, I want my wife and I both to get, let's say it comes out to $3,200 a month, so that if I pass away, she's going to get that same $3,200. Maybe I want to joint survive with a 50%. So maybe instead of $3,200, maybe I'm going to get $3,500. And then whenever I pass away, if I pass away first, she's going to get 50% of that $3,500. So again, that's all in the pension calculation. We can run through that with you. We can run through it on a cash flow analysis to show you how that plays out as well. Then there's uniform income, which is something kind of unique to Chevron. Some companies have them, but very rarely do they have that anymore. And we don't tend to see people use this, but it's an option where what's going to happen is you're going to have a level income before and after Social Security. So they're going to give you a higher pension prior to Social Security kicking in. Then once Social Security kicks in, they're going to reduce that pension so that those offset each other. And you're still going to get the same amount. Now, one a lot of you have questions about, and what we tend to see all the time, 90% of the time, I guess I would say, is the pension lump sum. That's what everybody talks about and wants to know about. So we'll get to that in just a second. But that's essentially taking into account that $4,000 a month example I gave you and saying, okay, how old am I? Let's say I'm 60 years old. Life expectancy maybe is 86 years old. So there's 26 more years of potential payments. What's the current interest rate used? And they'll do a net present value calculation to figure out, okay, how much does Chevron have to give me for me to essentially try and go out there and recreate that $4,000 a month for the rest of my life? And interest rates definitely have a big effect on that. We'll show you in just a moment. But the other question is, how much of my pension am I going to get? This chart right here is kind of busy, obviously, but what's going to happen is, just like we talked about previously, the point system, they're going to take a look at your age and years of service to figure out your points. I would say for the most everybody that we're talking to, that you're going to be, unless you've had a transition or just came on recently, you're going to be looking at that right-hand side where you're going to be probably over 55 points. And so one of the easiest things to kind of think about is age 60 is really where you're going to get 100% of that pension. If you were to take it earlier, it's about a 5% reduction each year. So let's say somebody were to retire at 57 because they took the EOI. There's a couple things to go through with that. Looking at age 55 rules in the 401k and things of that nature. I would just simply say anybody that's retiring or taking the EOI, give us a call to run through all these ins and outs. Even if you don't want to work with us, just make sure we kind of check what you're doing. But what's going to happen is, let's say that person retires at 57, so instead of the 100% pension, they'll be getting 85%. But they have the option to say, okay, well, I don't want that 85%. I don't want a 15% haircut. I'm going to wait and defer my benefits out till age 60. So now they get that 100%. But if they're taking a lump sum, they have to factor in interest rates, so it becomes a little bit more complicated, and that's where we get into really helping you guys out to figure out what that difference is and what the opportunity cost may be as well. So getting into the interest rate. So the seesaw pattern you see at the top, like I mentioned, interest rates are a big effect on here. Very simply put, when interest rates are higher, your lump sum's lower. When interest rates are lower, your lump sum's higher. And we've seen some dramatic swings over the last couple years or so. We saw them going artificially too low during the pandemic, which saw some of the highest lump sums we've ever seen in Chevron's history. And then that pendulum swung the opposite way, went too high post-pandemic, came back down a bit. Now it's kind of coming back up a bit, so we're kind of in a trading range here. But we're kind of in line with long-term averages now. But what Chevron does is they will go back. Remember that example I gave you, somebody who's 60 and they have 26 years left? They're going to look at the PPA segment rates, which are the Pension Protection Act segment rates. These are corporate bond rates. There's broken up into 3 segments. There's a first, second, and third. The first segment is going to cover the first 5 years of retirement. Second segment is going to be for years 6 through 20, and the third segment years 21 and beyond. So for that 26-year example I gave you, that means that middle segment is going to cover 15 years, so it's going to cover a larger chunk. So for most everybody, that middle segment is going to be the biggest culprit in how it's going to dictate things. So we'll take a look at that column here. But what they do is they actually are unique. A lot of other companies will do once a year adjustments or quarterly. Chevron will actually do month by month, and they go and take a look at the average of the previous third, fourth, and fifth month in order to generate what that's going to be. So we have a rolling monthly calculation here. So we do have February out, so that's going to give us the ability to go and project out till May. We're a couple days away from getting the March rates, so we'll be able to see what June's going to be at that point. But if we take a look at here, I'm going to zoom in instead of get my glasses. You can see that second segment. If you look at December, January, and February, you see that December to January jumped up. It dropped back down a little bit in February. But the key thing are those bold numbers below: May, April, March, February, January. If you see in January, we were at 4.92%, so one of the lower averages, and it started to climb up a bit, and it's been climbing up ever since because of those averages we have. So you're not going to have much of a change right now. But if we were to see interest rates start to drop, we might see this come down month by month. So for those of you that are looking at EOI and you're looking at going in June or July or something of that nature, you keep your fingers crossed. Maybe it comes down a bit. I wouldn't say it's going to come down much, but it could come down a bit, and we can run through those reviews with you. So we also do have some in-person seminars upcoming. So again, if you have any interest in those, give us a call at 800-900-5867. We can get you signed up for them. But we got one coming up Wednesday, May 7th, over in Houston at Fleming's. That's going to be over by the Energy Corridor. We've also got a couple coming up a little bit later than that over in California. One's going to be Walnut Creek over at May 14th, evening one at Roost Chris there. And then the next day, Thursday, May 15th, a lunch one over at LB Steak Bishop Ranch in San Ramon. So again, if you have any interest, want to get together with one of us in person to kind of go through some of those different options, or at least kind of see what we're talking about, that's going to be very important to do. If you have any questions, you can always reach out to one of us. This will give you kind of a quick glance at our Chevron team here. Myself, Tyson, Patrick, we've worked extensively over the years with the retirement group and helping Chevron employees retire. We just transitioned and merged with Wealth Enhancement Group last year, a much bigger firm, and there's some additional advisors that have extensive experience working with Chevron as well. And as far as at the end of the day, I know I kind of alluded to this and talked about it. Really, if you want to know where you stand, you need to run a cash flow analysis or a financial plan. Right now, about 3/4 of Americans over 50 don't have a written plan in place. You can rectify that by just simply giving us a call, and it could take as little as maybe 5 to 10 minutes if you got your stuff already in line. But there's about maybe 6 or 7 items we would need to gather to put that plan together for you. Give us a couple days to knock it out, and then we'll be able to sit down, kind of review that, and then go ahead and tweak it from there. Like I said, you could be saying, Wesley, I want to take the EOI, but I'm not sure about it. I don't know where my spending is. I need to look at a budget. I need to see if I can actually retire. And we'll go through all that and tell you, and I'm not going to shy away from saying you really shouldn't do it. If you can stay on for another 3 years, that's what you need to do. I wouldn't roll the dice on this, or we might come out and pleasantly surprise you and say, yeah, you could have left last year if you wanted to. Now you're just getting an extra bonus by getting the severance. So go ahead and pull that trigger. So any questions on there, just give us a call. And then a quick reminder who the retirement group is. Again, we're an investment advisory firm that focuses on working with corporate employees, helping them transition into retirement. We've been doing this for over 30 years. Myself and some of the other advisors focus on specific companies, Chevron being one of them. We tend to focus on just a select few companies because it allows us to have a deeper understanding of your specific benefits plans, whether it be the pension, the 401k, the stock incentive plans, healthcare retirement medical benefits, life insurance continuation, things like that. We've been there, we've done it, we know where some of the potential mistakes are, so rest assured we can kind of guide you through that process and help you out. We have offices throughout the country. Like I said before, last year we merged with Wealth Enhancement Group, so a larger firm now, about a little bit over $100 billion dollars under management, a little bit over 100 offices across the United States. So rest assured, if you need to sit down with one of us face to face, we can likely accommodate that. But obviously, if you want to talk via phone, email, web meeting, those are all available as well. And at the end of the day, that complementary cash flow analysis, that's definitely something that I do recommend. Even if you did one with us a year or two ago, it's been a little bit of time. The markets have changed, the interest rates have changed. It's good to get that updated as well, because that's a living, breathing document. We tend to update that annually for our clients, and we'll be happy to do that for you as well. To, like I said, worst case scenario, show you where you are. Best case scenario, kind of walk you through what the options are and kind of start that relationship and move forward with the retirement group. So with that, I'm going to wrap this up. I did see some questions come through. I'll get to a couple of them, and then we'll if we miss some of them, we'll let you we'll follow up with them individually. But if you want to schedule a meeting, there's a couple QR codes up here. One to get into our calendars to schedule a meeting with us. A lot of us keep our calendars on this system blocked about a week out, so it probably won't show you the next week. But if you want something quicker, just give us a call. We'll be happy to get you on there. You can go to our LinkedIn page if you want to stay on top of information we're providing, especially Chevron specific information. You can reach us at info@theretirementgroup.com, and you can also reach us at 800-900-5867. Okay, a couple quick questions. One coming in here. How does NUA affect me if I have if I have EOI? I'm losing the way to speak. So this actually, it's a pretty good question. NUA is something we didn't get into this time, but we do on a lot of our webinars, and that's another reason to call us, especially most of you have ESOP money in the 401k plan. So low cost basis stock on the Chevron, which allows you to exercise NUA, which is net unrealized appreciation, allows you to pay taxes on the cost basis and long-term capital gains on the earnings. I'm not going to go through all of it right now, but it's definitely a benefit to most of you, and it could be substantial for some of you. But as far as exercising it, that's something where there's some different limits as far as typically you have to wait till after you retire or turn 59 and a half. And if once you decide to do it, you have to roll over the rest of the 401k. Or if you take a withdrawal, you have to exercise NUA by the end of that year. So be very careful about that. I would say everybody's different, but I think one of the things you'll be pleasantly surprised about the retirement group is we're not going to shy away from telling you, hey, as much as we would love to manage your money, we don't think we should do it right now. Maybe you're somebody who's 57 years old and you're doing EOI. Maybe you're taking the pension lump sum. We can help you manage that. But the 401k, we might say, hey, keep this there, or at least keep a portion of it, so you have age 55 withdrawal options to get at it. It's less restrictive. Or we may say, you got some great NUA, but you need to wait until 59 and a half to do it. Or we might say, let's defer this out 1 year because, maybe you've got a year and a half worth of income this year because you're getting a full year severance, you're working half the year, maybe you got some other taxable issues if you've got incentive plans, so it may not be tax favorable to actually exercise NUA immediately. We may suggest to wait until January. So that's a really good question. I mean, if anybody's curious about it, just give us a call. We need to dig into that. We definitely need to kind of dig into that in more detail. And then let's see, one other question here. How do I this is kind of loaded. How do I cut my taxes if I'm getting affected and have some incentive plans? So I really can't go through all this right now, but obviously we'd all love to cut our taxes. Even if you don't have the incentive plans, I guess what this question is asking is somebody's in a good situation where maybe they're getting half a year of income, maybe they're getting severance, maybe they're also getting paid out on some of the restoration plan. Maybe they have some stock options coming due or restricted stock units. They might have a situation where they might have double their income as normal in this 1 year. So the question is, I don't want to kick up to a higher 32-35% tax bracket. How can I mitigate that? There are some ways, but really give us a call. Some direct ways, being in the oil and gas industry, there's some direct investment options you can do with that to cut down on some of the taxes. But generally speaking, what we're going to look at, let's say if you're doing expression of interest and you think you want to work for another year or two, maybe you go out and start your own business. There may be a lot of deductions you can look at there if you get that going quickly enough in this year. But if none of those apply to you and you're just looking for ways to reduce it, some of the best is going to be hopefully if you're charitably inclined. We can get into a lot of different scenarios where you can use a donor advised fund where you can front load a year's worth of charitable contributions into 1 year, so you get that higher tax deduction. Maybe you want to do a charitable remainder trust so that you're able to actually generate some income off of the charitable options, but get a deduction. Get that deduction, but still leave something to beneficiaries, or to the beneficial charity. There's a lot of different options to kind of go through there, but the three I would say would be potential tax beneficial investments if you're self-employed potentially, or charitably inclined. So just give us a call. We'll be happy to kind of go through those with you. And again, if we missed everything, we can follow up with you one-on-one. So with that, I want to kind of wrap it up, let everybody get back to work, or get back to whatever you're doing. But if you do have any questions, you can reach us at 800-900-5867. Even though myself and the other retirement group advisors have worked extensively with Chevron and we know most of the plans inside and out, that does not mean that we work for or endorsed by Chevron. But again, if you have any questions, just give us a call. We'll be happy to elaborate and give you all the information you need. Thank you, and we hope you have a great day.